Lots of comments on our blogs already.
Well, good morning, everyone, and welcome to another edition of Friday Morning Live. Today is May 10th, 2024. I want to welcome everybody. And also, just to let everybody know, we've gotten many texts and emails and phone calls this morning. We did have some weather come through Tallahassee, but we are in the office this morning. We do have power. We've heard from most of our team members. Everybody is safe and sound, so thanks for the well wishes. We know we're all in this thing together in the state of Florida when these weather storms come through, but we are safe up here. There's some damage in and around Tallahassee, but I think we're all in pretty good shape. Right, Kyle?
Yeah, 65,000 people without power right now, but all of our folks are at least accounted for, and be a little time before everything gets cleaned up. But thank you again for everybody who reached out to us this morning.
So you see today's topic with Kyle that just spoke, Laura Pearce. We're going to have her join in a second, and BG Murphy. So welcome all three of them. Just some housekeeping items. You see the co-hosts. Just again, a reminder that we do each week on Friday Morning Live is the classes that are available each week and throughout the month of May, and certainly leading up to our convention. But those are the classes for the next few weeks. So please get on our website under the Education tab and take a look if you need some hours. Certainly the E&O stuff and some of the member benefit classes that you can take advantage of as a member of FAIA. So I want to remind everybody, this Monday, at the close of business on Monday, May 13th, is our early bird, so to speak, registration for convention. Convention numbers are off the charts. So if you've not registered for convention thus far, please get online today or by the close of business on Monday and take advantage of the $100 reduction in full registrations for the convention. So June 12th through the 14th at the Rosen Shingle Creek, and we are extremely excited, Kyle, to bring another great show to the members of the association.
Yeah, as you said, the numbers are off the charts. You know, we had a record year last year for attendance. This year is shaping up thus far to look to break records again. Obviously, some really high-profile speakers at General Session with Tim Tebow and Jamie Wisnat, the CEO of Auto Owners. So, you know, I encourage everybody, if you have not registered, please register soon. Take advantage of the early bird special. The hotel is full. We have a wait list, so we will do our best to try to get everybody accommodated. But there are, of course, overflow hotels and plenty of options in Orlando. And so we hope to see you in June.
Yeah. And again, if you run into a snag, please reach out to your member advocate or somebody else here at FAIA will help us as much as possible to get you accommodations. But registration is still open, and it'll still stay open, of course, but just the early bird will end at the close of business on Monday, May 13th. So, what are we here to talk about today? Post-legislative wrap-up. So I'm going to kick this off, and I've got to switch slide decks. But while we're doing that, Laura, Kyle, and BG, I thought it would be a pretty good idea to kind of just walk through, this session, some of the nuances of this session, and some of the obstacles that some faced as we were kind of navigating the waters here in Tallahassee about passing some of our legislative agenda, which is derived, just a reminder, folks, derived out of our summer leadership in August. And just a reminder, I know convention's coming up, but just it's not too early to go ahead and look at August 7th through the 9th. We'll be at the Ritz-Carlton in Sarasota. And that is when we set our agendas for the upcoming year. So if you want to engage in that process, we encourage you to take a look at summer leadership and join us there, because there's many things that are discussed through that legislative session. It lasts a few hours, and a lot of topics are discussed. And then we come out of that making a plan of work for the legislative team to work towards in the 2025 session. So with that in mind, Kyle, just kind of if you briefly want to talk a little bit about maybe some of the things people may not be as aware of what some of the obstacles were that we faced this year through in the session.
Well, I think you stole my thunder there,
Oh,
Dave.
I'm sorry.
Yeah, talking about our process. So I'll be very brief because while I had the great honor of representing this association as a full-time lobbyist for about 16 years, I don't do that nearly as much as I used to. And, now that is Laura and BG's job, along with the rest of our legislative team, outside counsel, so forth. But yeah, this session, I think, was one of the more difficult sessions that our association has really ever faced, primarily because we found ourselves at odds with many of our friends in the industry. And it all goes back to, something that ended up in our plan of work that was important to our members. It was important to our board of directors. And it was, meant to address some of the things that our members faced after Hurricane Ian regarding cancellation and non-renewal. And so, it was something that I think is worth repeating, that, our plan of work, both legislative and anything else that we do on an annual basis, is set by our members. It is set by our volunteer leaders, those folks who come and join us at summer leadership, sit through the council, committee, and task forces, develop recommendations for our board that they ultimately either approve or amend or don't approve, for that matter. But there were times during session where I heard people say, well, we didn't have an opportunity to weigh in on this. You didn't ask us our opinion. And, I can appreciate and understand that feedback, but it's also worth pointing out that summer leadership is where all of that happens. And that is for not only our agency members, but our associate members. That, we value those relationships and the feedback and work that we do together with those folks. And so, I would encourage everyone, if you feel strongly or just want to be part of the conversation, summer leadership is where that happens. And so to join us down in Sarasota, August 7th through the 9th at the Ritz-Carlton, for that meeting, to be able to be part of the conversation and provide your feedback on the strategic direction of the association and the upcoming annual plan of work, I would encourage everyone to do that. It's a great meeting. It's obviously much smaller than convention. For those who have not been there before, it's maybe not quite as overwhelming as convention can be for first-time attendees. But it is a great meeting where a lot of work gets done, setting the stage and the plan of work for, our upcoming year.
For some of the members that may not be as familiar about summer leadership, Kyle, is it open to everybody? Is it open to associate members? Is it open to people that are not on the committee?
Yes, absolutely. I mean, all of our members are encouraged and invited to join us, whether that's an agency member or associate member. I think, you may not necessarily have specifically volunteered for, and I'll just use legislative since we're here today doing a legislative wrap up. You may not have necessarily, volunteered specifically for the legislative council, but you show up at summer leadership and want to attend that legislative council meeting, then you're welcome to do so. And all of our members, that is a pretty robust conversation that goes on there on an annual basis.
It is.
Having been a part of that now for almost 20 years. And it's a place where everybody can share their thoughts and ideas and try to come to some consensus to put forth a plan that the board will review and ultimately, approve or amend. But yes, everyone is invited to take part in that.
And again, we'll close the loop on this, but just a reminder, if you have an issue, right, and you can't make it to summer leadership, reach out to Laura, reach out to BG, Kyle, myself, anybody on the team, and we will bring that forward. We're already putting things down on paper of items
Sure.
that have already come forward.
That is really where much of the agenda starts, is the feedback that we have received throughout the year from our members. It doesn't necessarily need to be a member of the Legislative Council or on the board or any committee or task force for that matter. We develop that agenda, and there's time during that meeting to discuss other issues that may not be on the agenda. But the
Right.
agenda is developed by, the feedback that we have received throughout the year from our members saying, hey, we really think that FAI should address this.
Okay. Again, folks, just, we'll talk about it again, and certainly you'll see a lot more details about summer leadership. Certainly Kyle sent something out this week encouraging folks to volunteer and be part of that. But so let's turn our attention to the 2024 legislative session and bring in Laura Pearce. Good morning, Laura.
Good morning.
And BG Murphy. Good morning, sir.
Good morning.
So let's turn our attention to 2024, right? The legislative session, some of the bills that were part of our plan of work, things that came to us through that process Kyle just mentioned, but also things that we follow on a pretty routine basis that will impact not only our members, but certainly the industry at large. So House Bill 1611. So who's going to kick it? BG, you're going to kick us off with this one?
Yeah, I'll take this. And just a brief little note about this session. This year, following 2023, 22, 2019, all of the years in recent years that we've seen substantial property insurance reforms. What was interesting about this session is Governor DeSantis, House Speaker Paul Renner, and Senate President Kathleen Passidomo each individually came out this year in the months leading up to session and stated, because of what we've done in recent years, we don't have a lot of interest in pursuing additional insurance reforms. But as Laura will confirm, I think we tracked close to 100 bills this session that were filed amongst the members of the legislature. And so as we've continued the messaging about, all of the positives that are coming out of recent reforms, they're still hearing from their constituents about not seeing the rate relief that they had hoped for. And because of that, insurance continues to be one of the top political issues of interest for consumers. And the sheer number of bills that were filed this session were very indicative of how many phone calls are getting back in their districts. So, moving back to House Bill 1611, and I'll just very briefly piggyback on kind of what Kyle was talking about. We had a separate bill this session that did not pass the legislature. I will say that, the bill made it all the way through the Senate, passed off the Senate floor, and made it through all three committees of reference in the House without a single vote of opposition. But this was a piece of legislation that Kyle was alluding to, dealing with cancellations and non-renewals of policies following a catastrophic event. This bill was one of those that, we worked with industry stakeholders on, and we're very careful on our messaging because it wasn't really a result of bad actors. It was, at least in our opinion, was a result of poorly written statutes that leave the door open for a lot of ambiguity on when companies can get off policies if there's damage that occurred during a state of emergency. And so while that bill did not pass, there was one piece, which I'll get to in that second bullet point, or no, excuse me, on the next slide, but we'll get to that in a second. So there was a component of that bill that was part of our bill that did not pass, that we were successful in working with the Office of Insurance Regulation to get them to include in their bill. So House Bill 1611 was the OIR's kind of what we'd call an agency package. Each year, the OIR and DFS go through all of their statutes across all of the different chapters in law, and they look for updates and different things. And very similarly to what we talked about with our process, the state agencies go through a similar process where they bring in their division heads and talk through their regulatory statutes and, seek feedback on what updates are needed. So following in the line, I think there's been a data reporting requirement bill at OIR just about every year for the past 5 years. But the first bullet point is requiring companies to provide their used to be annual, but quarterly information, now monthly, and down to the zip code level instead of the county requirement. So as OIR is trying to get a better outlook on what's happening in the marketplace, they wanted to get some additional, more granular information on what's happening in the marketplace across the state, but going all the way down to the zip code level.
Is that part of the Quasar reporting process? That is an ongoing.
Yes,
okay.
sir. That information is still marked as proprietary and trade secret, but there are components of that information that they include in reports that they provide. They're publicly available that they provide to the Senate President and the Speaker of the House and the Governor. So there are components that is available to agents, is available to consumers, but it's all in an aggregate form in a report that's published by the office. The next one is there's a long-standing law on the books that says that the OIR, if they intend to roll off 10,000 or more policies in a 12-month period, they're required to notify the office. And so the office, in an effort to get a better idea of why companies are doing that, they included some language that requires a company 90 days in advance to provide information as to why they are going to be rolling off 10,000 or more policies in a 12-month period. So again, just another way for the OIR to have a better pulse on what's going on in the marketplace, where companies are writing, where they're looking to get off risks, and give them a little bit more of a heads up and give them a little more flexibility to respond as needed. This is going back to the bill that I mentioned earlier that did not pass, the policy cancellations and non-renewals. So in current law in Chapter 627, there is a provision that is invoked when the governor issues a state of emergency, the insurance commissioner issues a subsequent regulatory order. And essentially what those do is they outline the protocols for what companies can and can't do following a catastrophic event. We received a tremendous amount of calls and questions from agents who were dealing with specific circumstances or situations, I guess, following Hurricane Ian. And part of that was, and our bill dealt with kind of three different things, was the office able, did they have the regulatory authority to apply these standards, given that they're in Chapter 627, which regulates admitted insurers? The office has always said yes. It has always been interpreted, and they do that through their order by waiving a separate statute in Chapter 626, saying that unless otherwise stated, the provisions of Chapter 627 don't apply to surplus lines companies.
So that's to apply that statute to surplus lines. That's what they've done in the past in their orders, is waive that statutory provision so that they can apply the same statute that applies to admitted insurers to surplus lines insurers.
And so when we had the insurer accountability bill last year, there were some changes made to this statute. And when the bill was first filed, it applied the changes that they were making in the insurer accountability bills is expressly to authorized and excess and surplus lines companies. As that bill moved through the process in 2023, through the amendment process, surplus lines were pulled from that. And so there were some in the industry that made the argument that that was legislative intent, that they never intended for that provision, that existing provision, to apply to surplus lines companies. And so the office wanted to clarify in statute that they did have the authority to apply that to surplus lines companies.
Okay. So we'll keep moving and talk about some more provisions in 1611 dealing with hurricane modeling.
Yes, so this is an issue that has poked up over the past few years, and this is part of how companies do their filings. This was a industry-driven provision right here, and they wanted to provide clarity on what types of modeling they could use when doing their projections. And so basically what it says is if they use a weighted model using two different models, that they have to do that on an entire state basis, and they have to provide justification for the rate that's commensurate with that. The second bullet point was citizens insurance. As you all will remember, was it last year that they made the change?
Were they consolidated?
No, on
I'm sorry. The rate, yes, the rate
rates.
charged for policies that go to citizens
That were results of
I believe
insolvency.
that was last year.
It was, yes.
This was a priority of, really of one person on the Citizens Board of Governors. But essentially, as Citizens has looked to try and depopulate and to make sure that people aren't coming to Citizens solely for pricing, there was a law change last year that went into place that said if you were a consumer who was insured by a company that went insolvent, and you had an open claim and you ended up at Citizens, you could not get Citizens standard glide path rates, that you had to pay, I think it was no less than 50% of the rate that, well, what was it exactly?
The rate increase couldn't be.
The rate increase could be 50%.
Couldn't be more than 50%.
But they wanted to make sure that people weren't coming in and getting a rate reduction as a result of that. Well, there was a lot of pushback on that over the past year, because ultimately those people were not going to Citizens out of desire. They were going out of necessity. They had an open claim with FAIA. Due to no fault of their own, their insurance company had gone insolvent. And so that new provision was stricken out of statute this year. So that was very short-lived, only in effect for just a handful of months. And they'll go back in and pay the standardized Citizens rates when they come in.
You know, BG, we continue here at the association to get examples from many of our members and consumers. You know, we talked to a roofing contractor here recently about his concern of what's happening within his own industry, of people going out and about talking about free roofs, right? And so we continue to get these examples, and I know these inspections, there's a provision here that talks about that. But in general, if a member has a situation where they feel like maybe that group is not maybe doing the right thing by the consumer, how can that process get relayed to us, or what division within the state can they make a complaint?
So it's not a clear-cut answer to that question in all instances. If there is someone who is out there trying to provide adjusting services but not being licensed, obviously that would come to the Department of Financial Services. So much of what we've heard about on, roofers as of recent, the past few years, where roofs have been the hot topic of the year, a lot of that comes down to unlicensed activity on the contracting side. And so I would highly recommend, and we've published it, you can, I'm happy to provide that information, but you can file, if it's someone who's acting as an adjuster who should not be, obviously that would go to DFS. They have a complaint on their webpage, a portion where you can go in and file a complaint for unlicensed activity, but also the Department of Business and Professional Regulations. As part of this, Governor DeSantis has been very clear that he wanted to put some skin in the teeth of some of the third-party actors that were causing the problems. And he has put a charge on DBPR to really come in and go after that unlicensed activity and people doing things that they shouldn't do. But even looking at previous bills in previous years with dealing with how they communicate with consumers or how they advertise their services, the laws have changed on that as well. So this change was really just kind of a clarification in law. It was saying that a certified roofing contractor could serve as an inspector for the purposes of determining roof age. As the law changed last year as well, to give consumers the ability to have their roof inspected to see how much remaining useful life they have on their roof. But highly recommend, Laura and I and Kyle, Dave, you as well, get emails almost on a weekly basis of some kind of issue with somebody and something to do with roofs. So whether it's a roofing contractor or adjuster, it continues to be a focal point amongst regulators in state.
Yeah, the latest example we got from one of our members here in Tallahassee and actually talked to his client was, his concern was you've got all these people coming from out of state, right? They're coming into our areas and they're infiltrating neighborhoods all at once. And so it's just from his concern, he's been a roofer here for 30 years in Tallahassee, and he just said, enough's enough. I can't keep doing this, because he's getting calls from clients going, why? You just put a new roof on my house. What are we doing here? So just, let us know if we can help in that. And then the last bullet point here, there's been a trend here for the last year to 18 months of new capital coming to Florida and setting up shop here and using the reciprocal model. Kyle blogged about this several months ago. We get questions from time to time on this, but there was something in this bill, BG, that just kind of clarified how these new entities need to report.
That's right. So there's different sections of laws, several chapters, which is why I take Laura everywhere I go, because she knows all of them by heart. But they, as reciprocal insurers are addressing a separate portion of statute, they wanted to make sure that all of the same framework was applied across the board for admitted companies. And so they went ahead and updated those statutes that expressly dealt with reciprocal insurers to ensure that they were falling under the exact regulatory system as every other admitted company.
So to be, abundantly clear there, there's no changes. The legislature didn't make any changes to, how a reciprocal operates, what they can do, what they can't do. This was strictly regulatory in nature, verifying and clarifying that they are regulated the same way that any other admitted carrier is regulated.
Yeah. Okay. And then we switch to next up, 1503, part of the citizens package. And I know this has been a hot topic, and it still continues to be a hot topic of flood coverage requirements under if you have a citizens policy, BG.
So this was one of the big issues so the sponsor of this bill was our dear friend, Senator Jim Boyd, and he was very gracious, as he always is, with allowing us to, kind of take a look at this bill and make sure that, from the agent and consumer perspective, that any effort from the state to depopulate was looked at through the lens of the agents. And so one of the big issues that we had gotten a lot of calls on over the summer was this new citizens flood requirement. And when that was phased in, it originally applied to commercial, residential, and personal lines residential. And when they added it in, there wasn't a whole lot of verbiage behind it of what was required. It just said coverage that was readily available at the NFIP. But as agents started dealing with this, they started to see that, they were getting a lot of questions on whether or not that flood policy had to have contents coverage on it as well. And so a trend that we started seeing in the marketplace is that consumers were opting out of contents on their homeowners policy so they didn't have to have it on their flood policy as well. And that certainly was never the intent of the legislature. So what they did is they came back in and clarified that for the purposes of the requirement to have flood coverage is a requirement for eligibility at citizens, that you only had to purchase coverage on the dwelling, not on the contents as well.
Yeah. And then switching gears, I know this was something that certainly raised a lot of eyebrows every time in the legislative process when you mentioned the word surplus lines. So this provision and some of the nuances of this were heavily discussed and certainly debated. But this is the result of what came out of the bill.
So this bill, when it was originally filed, this was the purpose of the bill, was to authorize surplus lines companies to participate in the takeout program. This is something that we have talked about with our legislative council going back to summer leadership for years. And in historical relevance, our members have traditionally taken a position of support, neutral to support, so long as there are a few considerations in place. Probably most important is making sure that doesn't diminish any of the consumer choice protections that exist in statute, and make sure agents have rights to or expirations and making sure consumers can continue to work with their agent of choice. And so when the bill was first filed, that actually was not included in the bill. In fact, the bill expressly exempted those statutes, so they didn't apply. And that was the very first thing. As Laura was reading the bill, she skimmed through it, as she always does, very quickly, and said, this ain't going to work. And so that was the first big change that we got put in, was to make sure that consumer choice still applied, and allowed for agents and consumers to continue to have that relationship and not have that impacted by a state's decision to depopulate policies. Additionally, when the bill was first filed, again, it applied to both personal residential and commercial residential. And that was the second thing that we worked on, was getting commercial residential taken out of that. There were just a lot of concerns given the complexities of the commercial residential marketplace, and really wanted to start the discussion just kind of focusing on the homeowner side. The bill also limits this, so surplus lines companies can only take out secondary homes. There's been a lot of discussion over the past few years, and these are not my talking points. This is just the proponents of the bills and other state leaders who've been involved in this, is that, these mega wealthy people that come and buy these mansions on the beach, which there are limits on how much you can get insured as citizens. So I don't think they're ever mansions. But that people's secondary homes, vacation homes, shouldn't be, in the state subsidized. I throw up air quotes when I say that, citizens insurance. And so this bill limits the ability for surplus lines companies to do takeouts on secondary homes. And with that, some of the other things that we worked on was to make sure that 20% eligibility criteria continued to apply, to make sure that people weren't getting, 60, 70, and 80% rate increases, to make sure that, if they had an offer within 20%, you don't have to take it, but you can't stay at Citizens. You have a fairly priced option available to you. But anything over 20%, obviously the consumer would have the ability to reject that takeout offer.
One other thing to note is that the Citizen statute defines primary residence as a residence where someone lives 9 months. So secondary residents, could be somewhere where they live 8 months of the year. However, we did get a provision added in that it also says homestead properties are exempt. So you can homestead a property, if you're splitting a residence 50-50. Then this would not apply to homesteaded property.
Yeah, I think that 20% threshold has certainly been very helpful in the depopulation uptick that Citizens has experienced over the last few depop offers. And so having this in this part of the bill as well will be helpful for those companies that want to participate. So something else that happened on the Citizens, for many years, as when they started at their inception in 2002, Citizens always had 3 buckets, 3 accounts that they had silos of funding and resources in. And so there's been a push over the last few years to try to combine those accounts for a variety of reasons, but that has been accomplished, which you see up on your screen there, what the purpose of it was and what they were trying to accomplish, mostly from a financial and a reinsurance standpoint.
Yeah. So Citizens actually went through that process, and they have officially merged all 3 accounts. So this was really a cleanup change that they put in statute, as there still were a significant amount of references to the 3 different accounts, but now that they've merged them into one account that will rule them all, they went through the statute and deleted all of the references to the 3 different accounts. And as part of that, they had to revise the signed acknowledgement, notifying the consumers of the risk of an assessment. And so those changes were made. A result of that bill that passed year or two ago.
And just a reminder, in the old bill, it was 15%, up to 15% per account if you were a Citizens policyholder. What's now, because they've all been combined, it's still up to 15%, but it's just all in one account. So if you have a personal residential account, or you're in the wind only account, or you're in the personal lines, you're still subject to 15%, up to 15% of an assessment. So, anything else on this particular one?
I do want to briefly hit on the second bullet point under operations and management. As this is related to, although we didn't specifically ask for this, this is related to an issue that we get calls on. It's probably one of the biggest calls that we receive, which is agents AORing policies over to other agents. And so we routinely get the calls about agents losing policyholders to State Farm and other companies that utilize that statute. But the citizens actually came forward with this recommendations, and under previous law, in order to have an appointment with citizens, to be able to write business with citizens, an agent had to have one appointment with one other company who's currently writing business in the state. As citizens looked at this issue, they took a lot of feedback from a lot of different interest groups on how they might address the AOR issue, but this was also part of the bigger depopulation discussion. Our policies ending up in citizens that weren't properly shopped. And so what they did is they went in and increased that number from 1 to 3. And so now, in order for an agent to write business with citizens, they have to have 3 appointments with admitted companies writing business in the state. So we don't think it's going to have a tremendous amount of impact on the kind of the separate issue of independent agents losing policies to State Farm agents and others, but it could, I suppose.
Yeah, just to close the loop on that, a conversation with our friends at Citizens this week. There's about 600 to 700 agents that are currently appointed with Citizens that don't have the 3 appointments. And so Citizens is reaching out to those agents, advising them of this provision in this bill and how they can work towards achieving that by July the 1st when the bill goes into effect. So, all right. So, Kim, we'll answer your question in just a second, but let's just move forward to My Safe Florida Home. Laura, are you going to pick this one up?
Well, I thought BG would.
We're going to stay with BG. Okay. But again, this has been around a while. There's a lot of good work that the department is doing with this. BG will go through some of the provisions in it, and certainly we'll turn our attention to something that happened this year to add condos in the mix. So go ahead, BG.
So Senate Bill 7028, I'd put more in the administrative update realm of bills. So the My Safe Florida Home program in the past couple of years has grown in popularity immensely. Last year, I think they appropriated about $250 million. And I think the applications for that $250 million had already sufficed the total amount of appropriations within like a month or two. And so as people are looking for ways to harden their homes and hopefully receive some mitigation, discounts on their insurance policies, the program has just naturally become very popular overnight. And as they were going through the process and seeing this program kind of be reinvigorated, they went through and started updating a lot of the administrative challenges that they were having. So clarifying when, a contract is, when it's not been responsive on an application, not a contract, application, providing a period of time where the consumer has not been responsive of, and when the state can determine that application no longer effective. It just changes like that within internal, making sure that DFS has the ability to go and request additional information from the consumers. But probably the biggest change that came out of this bill was it requires the department to prioritize the applications starting with low-income seniors and then kind of working back. What they found is there were a lot of people that were taking advantage of this program because of the volume of applications. There were many Floridians who were in dire need of these grants. And so they wanted the department to put in a prioritization schedule to make sure that those who really needed the resources, who didn't have the ability otherwise, make sure they had the first right of refusal when they were going through the application process.
Okay.
And then I think
Funding.
the funding is the last one, kind of the last bullet point on that. So for fiscal year 24-25, the legislature appropriated another $200 million for this program. That's something that we suspecting coming years will likely increase given the popularity of the program. But obviously with the new requirements of prioritizing applicants, we hope to see that $200 million, last a little bit longer moving forward.
Yeah. So switching gears, something that was added this year, Laura, was condos and a pilot program to try to encourage condo associations to get some of these grants.
Yes. So House Bill 1029 was the My Safe Florida Condominium Pilot Program bill. And it kind of set this up similar to My Safe Florida Home. As you all know, My Safe Florida Home funds are limited to single-family homes or inspections of townhomes. So condo associations in the past had not been eligible for that funding. So this program sets up something for condo associations. They've got to be within 15 miles of the coast. And I don't have that on a bullet point here, but we need to add that. But that is to be eligible for these grants. And they're matched on a 2-to-1 basis. $1 put in by the association for every $2 would be provided by the pilot program. The grant awards are limited to 50% of the cost of a project and a maximum of $175,000 per association. So some of these big associations, it's not much, but it's something. And frankly, the total appropriation for this is $25 million. So I suspect that will go quickly, but it's a pilot program, and depending on how it goes, the legislature would consider funding it next year.
Yeah, I just curious. 15 miles from the coast. That's a coastal condominium.
Yep.
But okay, that's how they defined it. That's what we'll work with. All right. Well, again. More part of the My Safe Florida Home program was the issues with public records and dealing with some of the things that are available through this program, right? And those protections.
Right. They just put a public records exemption in the statute for the home inspection reports and applications that they would have the department would have on file from My Safe Florida Home, so that an applicant's mailing address, phone number, email address, and pictures of inside of a home or something would not be included as a public record.
Yeah, and I think this was a good provision, right, BG? Because there were some probably would be unwilling to participate in the program if they knew some of that information was going to be made available to the public.
I could tell you I don't want pictures of my house being out there on the public records.
So. And then finally, we have House Bill 939, the Consumer Protection Bill that deals with certain things in our industry that, is on the side of the consumer and the protections that they should made available to them, as they go through this insurance process.
Yeah, so this was another one so as I mentioned earlier, when we talked about the OIR agency package, this was one of the CFO's, Chief Financial Officer Jimmy Petronis's 2 priority bills that were derived from the Department of Financial Services. And as we talked about roofers earlier, it was only appropriate that the first bullet point in this bill was dealing with contracts for roofing. So what they did is they came in and, obviously, the storm chasers, the pop-up roofing companies that come from out of state to try and profiteer off of these catastrophic events, is they put in a requirement that if someone enters into a contract for the purpose of repairing a roof or replacing a roof during a state of emergency, Florida law now requires that contract to have a right to rescission. So the ability for a consumer within 10 days to say, after they may have entered into the contract with the roofing company, but subsequently talk to their company or their agent to give them the ability to back out of that contract after they've signed it. So many people in these difficult times will have an expert, or so they think, come to their door and say, hey, you've got this issue. and they don't know any better. And so basically what this does is gives them the ability to back out the earlier of 10 days of executing the contract or the official start date of the work. And then it requires that cancellation of the contract be sent to the contractor in some verifiable form, whether it's a certified mail or any other type of mailing where they can prove receipt of mailing the cancellation. Just a minor change on public adjusters. It requires their contracts for services to contain their license numbers. Obviously, the state has been working to combat unlicensed adjusting. And so, as we mentioned earlier in one of the previous bills, they want to make sure that if someone is representing themselves as an adjuster, that they're including their license numbers. One of the big ones that the CFO really talked about a lot was an update they made in the notice of change in policy terms section of law. It now requires those changes to be published in the 14 font bold print, just to make sure that consumers are seeing the changes that are coming in when they receive their renewals. Make sure that they're fully aware of any changes that may be happening in their insurance policy that they need to know about.
Yeah, and let's just go to that last bullet point, BG, loss assessment coverage. This has certainly been a hot topic around this organization for many years, but most recently about how people viewed when the loss assessment coverage applied.
So this is one that we actually did have in our plan of work. We were currently dealing with the problem, which is that through the existing statutes, companies have gotten filings approved by the office that have two separate dates of loss. There are some companies that have forms that say the date of loss for the purposes of the claims filing deadline is the date of the catastrophe that led to the need for the assessment. There are other filings that are approved that support the assessment being levied on the unit owner as being the date of loss. And so what we were looking to do within our legislative recommendation was to just make that clear that there is no loss until there's an assessment. We receive a lot of examples of claims being denied because, especially under this new one-year claims filing deadline, that the claim was denied because the claim wasn't made within 1 year of the hurricane. Well, they may not have received an assessment until day number 364 and filed it a couple of days later, and they now are going to have that claim denied. So we were working to get some clarification made on that. The DFS, who we worked with last year when this issue was out there, and then again this year, came forward with a kind of an alternative recommendation, and the law will now require that any notice of loss for a loss assessment claim be provided within 3 years of the date of the hurricane. Within that, they create kind of a separate claims filing deadline to say that within that 3 years, they have to file it at no later than within 1 year of the date of hurricane or within 90 days after the date of which the condominium association levied the assessment. We worked extensively with stakeholders, with the Department of Financial Services, because we, again, were concerned that they were defining the date of loss as the date of the hurricane. And so I suspect that this will be one of the first things that's brought up in the legislative meeting this summer at Summer Leadership. Is this will likely be something that we need to come forward with this year to provide a little more clarity.
Yeah, for sure. So turning our attention to House Bill 989, CFO's bill, talks about workers' compensation and some of the changes in the Division of Consumer Services.
Yes, the workers' compensation changes were basically just reimbursement rates for emergency services. You can see there 250% of Medicare. That was amended to include that provision. On the two bullet points on the bottom of that page, the first, these are both
I'll bring it back.
Regarding surplus lines insurers, and the first provision talks about how when the Division of Consumer Services receives a complaint on a surplus lines insurer, this would require them to respond within 14 days after receipt of the complaint. That's a requirement that applies to admitted insurers, and so that would be carried over to surplus lines insurers. And the same with the second requirement there is they need to maintain a contact person and an email address on file with the DFS so that DFS can reach out to these surplus lines companies if there is a complaint filed.
And, you know, and this is certainly a good protection because as those of us sitting in this room and many agents on this call, this is part of the angst that a lot of had after a storm or really any claim where they can't get in touch with certain people, and 9 times out of 10 because of it's a property loss here in the state, it's surplus lines. So I think this is a great plan there. So switching gears, we're again 989. Talk about some licensure requirements, Laura.
Yeah, these are pretty basic requirements. I mean, you can read through them and see there's a new designation allowed for the examination to become an adjuster. One of the things that I can point out is this requirement that requires a licensed adjuster to identify himself or herself in any advertisements, solicitations, or written documents. Kind of a consumer protection there. And the last one was interesting. I actually talked to Greg Thomas at DFS about this and the reason for this. So under current law, a surplus lines agent that operates solely as a surplus lines agent doesn't transact any business on the retail level, still would be required to get an appointment for their 220 license and then have another appointment for their 920 license, their surplus lines license. And so this would say that one appointment with the surplus lines company would suffice for both the general lines license and the surplus lines license if that person was just doing business in the surplus lines market only.
Yeah. And again, a reminder, you can see all details about these bills in our legislative summaries online, right, BG?
That's right. We got a slide here at the end and walk people through how they can get to that and what all the information they can get.
So let's talk about taxation and some of the things that the legislature tried to do to offset some of the increases that are going on in the marketplace from a premium standpoint.
Yes. So as I mentioned earlier, as we were leading into session and kind of expectation setting on what we might see this session, one of the big things that was really driving the conversation, driving the fact that legislators filed 100 bills on insurance-related issues was the cost of insurance. Over the years, we've seen so many different proposals to try and reduce the cost of insurance, but obviously many of those would have had a profound impact on the marketplace and its existence. So one of the ways that, and this was a priority of the governor, the speaker, and the president, was they wanted to find some way to try and pass on some type of savings to the consumers. And so through the tax package, what they did is they went in and required insurance companies. So insurance companies pay a 1.75% premium tax on every single insurance policy. Now that's passed on to the policyholder. And then there's a separate charge that they pay. So insurance companies are required to pay 1% of their total premium collected. They pay an assessment to the Department of Financial Services, Division of Investigative Services, to the State Fire Marshal Regulatory Trust. And so what they've done is they've now waived those two requirements, and they require the insurance companies to pass those savings on to consumers. I do want to note that this is, it will be meaningful is in the eye of the beholder. It can be very meaningful for some people. It's probably not going to have the impact that many Floridians are looking for at this moment when they're seeing 50% rate increases, but it's something. And it's only in effect now for the 24-25 fiscal year. And so we'll see if the legislature comes back and does anything with that next year.
Yeah. So next up is House Bill 215, the risk retention groups. Laura, who's taking this one, Laura? But this has certainly been a topic that we get a lot of questions about here at the association. So
I'll take this one, then I'll let Laura hit the last side. We did take some bills off of the agenda to make sure we had time to get through everything. But risk retention groups have been around in Florida for many years. Over the past few years, there has been debate amongst the OIR and the Department of Highway Safety Motor Vehicles as to whether or not they were authorized to issue commercial auto insurance in the state of Florida. These groups actually operate under a federal exemption that allows them to operate in the state. But because they were not defined in law as an authorized insurer, the OIR and Department of Highway Safety Motor Vehicles, the systems they use to ensure compliance with insurance requirements, were flagging policies issued by risk retention groups. So essentially what this bill did was it codified what we were already seeing in the marketplace and made it abundantly clear that they are authorized to issue insurance in the state of Florida.
Okay. You know, and here are some bills that we couldn't get to today. So, but if you come to convention, we'll address those as well. But, you know, some of the disclosures dealing with flood, Laura, certainly a hot topic. 1021 is community associations. We get a lot of questions in and around that topic.
Yep, and cybersecurity.
And cybersecurity.
Yeah.
Yep.
Just interestingly enough, I mean, we put these at the end for a couple reasons, but one is all of the bills we've discussed up until now have been signed by the governor. So these on this last slide have not. We don't expect that they won't be. It's just they haven't been sent to the governor yet for his signature.
Yeah. So there was a method to the madness. I understand. So, but BG, before we end today, this is something that we just want to remind everybody that's available to them as a member of the association to be able to go in and see what we do post session about summaries of each one of these bills.
Yes, a big plug for the advocacy homepage on the FAI website. We publish a lot of information, leading up into session. We post 300 worders and different materials about the issues that we're going to be advocating for during any specific session. But as you mentioned, the legislative summaries. So we publish a summary of every single bill and highlight all of the issues within bills that agents will want to be aware of and additional information so they can go in and learn a little bit more about the laws. So you just go to either click on advocacy at the top and then just scroll straight to legislative summaries, or you can click on the advocacy page and make your way there if you want to see some of the other information that we have on that web page.
All right. Well, we still have a few minutes. So one of the questions that we'll go ahead and answer that was written by Kim was before Citizens had the 3 accounts, it was subject to 15% per account up to 45%, and is now 15% because there's one account. It's all lumped in there together. And so, yes, Kim, it's now, if you're a Citizens policyholder, you're subject to up to 15% of your premium in an assessment. And then there's certainly other assessments that go along with that. But if you're a Citizens policyholder, now it's limited.
Right. So it would be 15% for all Citizens policyholders. And then if that was not enough, given a catastrophe, then it would be all policyholders.
Right.
In Florida.
And right now that provision is up to 10%. So,
right.
So that's where we are. Any other questions, certainly post them. We're running up on the hour. But before we adjourn, I thought since Kyle stayed in here, I thought we'd just finish up, Kyle, with, a lot of this has been helpful. But last year, with a lot of the changes we're starting to see with tort reform and other things, we're starting to see some stabilization of the marketplace a little bit, Kyle, and starting to see. We saw some rate filings recently with a couple of carriers reduce rates. I know it was very minimal, but they did. But part of the reason they did is they were pointing to the reduction in some of the litigation costs that they were experiencing for their company. But so as we go off air today, just any thoughts on what you're seeing and as far as the marketplace and some stability that I think we're starting to experience?
Yeah, I always get nervous, opining here because, all the folks on this call are the folks that are actually writing business every day. And so what do I have to say that you don't already know? So at a very high level, the last 2 quarters have shown really a big change in the financial performance of the market, going from, year over year, going from, really large losses to actually profitability on the aggregate for the industry. That's obviously a positive sign. We've said all along that progress was going to be slow, as it's specific to both capacity and pricing. But we are starting to see some of that. And I think our members are starting to see some of that. I think the one thing that, maybe hasn't happened as quickly as some of our members would have liked is new carriers. I know that there was recent published memo from the commissioner relating to new carriers who have been authorized here in Florida. I think they listed 8. That's a great thing. It's progress, but I think 6 of those 8 carriers were subsidiaries of existing carriers, and some of them may be where policies are going to be transferred to. So a lot of those new carriers that have in fact been have gotten their certificate of authority aren't really writing a lot of new business. There's a couple, and then now we find ourselves in a situation where, whether you believe it or not, it remains to be seen at the end of hurricane season. The forecast for this season is for a very, very active storm season.
Yep.
And so I think that has also had a little bit of a chilling effect, both on new entrants coming to market before the hurricane season. And I think it also has some reinsurers, sort of, being cautious. So everything that I've heard up to this point, treaties for most carriers need to be signed and programs need to be in place. Reinsurance programs need to be in place by June 1. Some carriers have different renewal dates, but by and large, the industry has to get all their reinsurance in place by June 1. And the information that I have received up to this point is that there's capacity available. There's more capacity than was available in previous years, and pricing overall is relatively flat. But of course, that depends on the carrier themselves.
Exactly.
And their past history of losses, how they handle, claims and so forth. So, but that's a good thing, after years of increased reinsurance pricing and limited capacity. The fact that there is ample capacity in the market and reinsurance pricing is looking to be relatively flat across the board. That's a good thing. So I think, to summarize all of that, there are some positive signs. I know that there are some carriers who are relaxing underwriting guidelines. As you mentioned, a couple of companies have filed for, albeit modest, rate decreases. They are decreases compared to what has been filed over the last couple of years. And so hopefully, knock on wood, the forecasters are wrong for this upcoming hurricane season, and Florida is spared, and we continue to have more stability and predictability in the market moving forward.
Yeah, great point. Yeah, stability for sure. And so thanks for those comments. But thanks for everybody for attending Friday Morning Live today on May the 10th. We really appreciate you tuning in this morning and learning a little bit more about the legislative process and some of the bills. We hope to see a convention in a couple of weeks. We're 5 weeks and counting, or 4 weeks, and we're close. I know that. A lot of busy people in the building when we're open. So
4.5.
4.5. Okay. So, but yeah, if you can, we look forward to seeing you, and certainly we're available to have these discussions in person down there as well.
Absolutely.
So, but thanks everybody. Be safe. I know this weather is passing through us and probably in other parts of the state. So be safe and have a great weekend. And thanks for tuning in to Friday Morning Live.